Morning, I'm Bennett Tchaikovsky. This is creating common size financial statements using financial statements from sec.gov. This is my disclaimer and copyright notice. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share the links on an unmodified basis. If you modify the presentation in any way, please email prior to doing so. And this is my email address. And I do not claim any copyright whatsoever in any companies or organizations mentioned in the presentation. Rather, the other parties are the owner of their own respective copyrights. Okay, so today we're talking about common-sized financial statements, which is really important when we are doing ratio analysis. The first thing, and really what are common-sized financial statements? Well, ultimately, we're going to be showing our balance sheet and our income statement as a percentage of either total assets or total revenues. But doing common-sized financial statements gives us the ability to compare maybe a company like Sprouts with Kroger, to compare a smaller department store to a larger department store. But when we're going through and doing this, we just have to remember as well is that we need to make sure that we're choosing companies to analyze ratio-wise that are in this similar industry. For example, JetBlue, Southwest, United Continental Holdings, Inc., which is United Airlines. You can add whatever you want to it. The service is going to be just as crappy. American Airlines and Delta Airlines. General Motors and Ford. Those are pretty comparable just because of their size. Nike and Under Armour, those can be compared. But then you get to a company like Tesla, and Tesla is extremely unique in that it also embodies SolarCity. Another company that would be kind of difficult to compare would more than likely be Netflix. And some of you might be saying, well, what about Hulu? Challenge with Hulu is that it is privately owned, or it's owned by several large entertainment organizations. So, and again, it's going to help us by creating common-sized financial statements. This is going to help us compare these companies. And just to see what I mean by what is common-sized, what we're going to be doing a little bit later today, hold on. So what we mean by common size is I'm taking a company here like Lowe's and I'm converting their income statements into percentages. So I'm taking here their net sales and making it a percentage. When I go over and look at, say, for example, Home Depot, I'm also, even though the numbers are different, right? So for Lowe's right here, their total net sales was $68 billion. And here for Home Depot, their total sales was $100 billion. We can kind of make comparisons, say, on gross profit. Home Depot had a gross profit of roughly 34% on the sale of their merchandise, while Lowe's had a 34.11. So as you can tell, it's relatively the same, or slightly different. It looks like Home Depot is slightly less than Lowe's. But as we go through and look at some of the other categories, this is going to help us better analyze it. So let's go back to our presentation. And presenting. Okay. So the first thing we have to remember is we have to find companies that are in similar industries. And if we're choosing something unique, then we're going to have to kind of make sure that we are looking at the appropriate side of it. For example, if I was to be looking at Netflix, probably one of the comparables I could use would be Prime Video, because Amazon does make its own content. but not necessarily to the extent of Netflix. Now, if Amazon reported their Prime Video content separately as a separate unit, I may be able to go through and see if that would work. So again, we want to choose, and this is, so when I teach financial statement ratio analysis, which is a very important part of financial accounting and also of managerial accounting, the first thing we need to remember is that you're going to be given a huge list of ratios. And the biggest mistake students will make is they say, I'm going to compute every single ratio. And that's not the way to go. The way you want to go is you want to choose ratios that are the most meaningful to you when you are looking at a company, right? Meaningful. For example, there's something called an inventory turnover ratio. But if the company you're analyzing has no inventory, or the inventory amount is relatively insignificant, then why are you using that ratio? It doesn't make any sense. You should only be computing ratios that are meaningful to the analysis of that particular company. Conversely, if a company has no receivables, the accounts receivable turnover ratios are meaningless. They don't really have any meaning to a company that has no receivables. When we look at companies like Lowe's and Home Depot, inventory is a huge part of their balance sheet. And therefore, when we are analyzing Lowe's and Home Depot, we want to be looking to see what their inventory turnover is. Accounts receivable, however, for both Lowe's and Home Depot they're relatively insignificant. For Lowe's, it's probably a part of other assets. Home Depot, I want to say it's around 5%. But in any event, when we are choosing ratios, we don't want to just blindly go down the list and start computing things. We want to really see, well, which ones are going to be more meaningful. And by doing common-sized financial statements, we can really see what ratios are going to be the best for us to use. So how do we do it? How do we find financial statements with sec.gov? I'm attaching this video to another part of my playlist, which will show you how to look up a ticker symbol for a publicly traded company. But right now, we're going to go pull up a financial statement for a publicly traded company. So as of right now, we're in a SEC governmental shutdown, but what's so awesome about the SEC, Securities and Exchange Commission, is they're keeping their website running. So the way we're going to, which is good for us. So the way we're going to do this is in terms of how do we find the financial statements for a company that I'm looking at. Remember, I can't find in and out on this. Sorry, East Coasters. That's one thing that's awesome about being on the West Coast. But I can't find an in and out because in and out is privately held. But if I go over here to, I go look at a company filing, say if I want to look up Home Depot. So I'm just going to type in the ticker symbol, and again, take a look at my prior presentation on how to look up publicly traded companies. I type in HD, and I get to the Home Depot. And this is going to be giving me all of their filings. Now, I want to pull up their annual report. So I'm going to go to something called a 10K, and I'm going to search. And what's going to happen is that this is going to pull up all of the 10Ks for Home Depot. The next thing I'm going to do, right, so I type in the ticker symbol, then I go to this part here that says filing type. And what is a 10K? A 10K is an annual report. A quarterly report is every 3 months, 3, 6, and 9 months. The 10K is the annual report. Most of the time when you're doing financial statement analysis, you're going to be using the 10K. Now, if we're going to get fancy and we're going to be an analyst, we're going to do something called trailing 12 months where we look at everything as a quarter and we kind of build that into a spreadsheet, but that's not what we're doing today. So I'm going to go over here to the 10K. I'm going to click on interactive data. Notice here the filing date was March 22nd, 2018. essentially Home Depot, their last filing that they made was December 31st or January 31st, 2017 or 2018. And what we're going to do right here is we're going to click on this. This is January 2019 right now, but their filing is not yet due. So we're going to click on interactive data. And what's going to happen here is we're going to get to Home Depot. And it's going to show us different parts here for financial statements, consolidated balance sheets, and it's going to give us a summary, which is really, really nice. But what's even more awesome about sec.gov, which is even working during the shutdown, is right here, I'm going to click on View Excel Document. When I click on View Excel Document, this is going to download, essentially, I don't know if you can see this on your screen, but it is downloading the Excel file. So for your benefit, what I've gone through and I've done is I have uploaded these Excel files into Google Sheets, which is another really easy thing to do. So what's going to happen here is that all these different sheets here that I've created here in Excel, this all came from the SEC's website. So again, the way I've gone through and I've done this is I looked at right over here. We'll go back a little bit. Or it's probably, this is me repeating myself as an instructor. It's you guys are probably saying, hey, Tchaikovsky, look, yeah, we can just rewind the video, but if you want to do this again, that's great. So I go to sec.gov, click on go to fast search, I type in the ticker symbol. What is the ticker symbol? It's essentially the company name that, or basically the ticker that the company uses on the relative exchange. Type this in, and then if I want to look up a particular filing type, I go to here, I'm going to use 10K, click on interactive data. This is going to right here will get me to the View Excel Document. So now that we have our financial statements in Microsoft Excel and I've uploaded them to a Google Sheet, now we're going to go through and make the financial statements what we call common sized. And the way we're going to do this is we're only really looking, and I've never done this for a statement of cash flows. I would really just don't do it only for the income statement and the balance sheet. If someone wants to email me why I should do it as a cash flow, I would love to hear from you. But you really are only going to do it on the income statement and on the balance sheet. Now, for the balance sheet, we're going to divide every amount on the balance sheet by total assets. And to check our work, our total assets should be 100%. For the income statement, we're going to divide all amounts by total sales or net sales, net revenue. And the very top of our income statement should be showing 100%. Note here, when it comes to shares outstanding, when it comes to earnings per share and the like, we are not going to show those as a percentage of total revenue or assets because that is not a meaningful comparison. It's not apples to apples. And the reason why is earnings per share is a function of the company's earnings divided by shares. And that's not really something we're looking at in terms of being common sized, at least from this part of the analysis. So now what we're going to be doing here is let's go back to our examples, and I've kind of jumped ahead for you and I've done part of this already. So here we have a consolidated statement of earnings. Now, what I've done here is I've divided everything by net sales. So for the 12 months ended February 2nd, 2018, what I did here was I divided this amount and I divided it by the same amount, or B4, which are my total sales or net sales. What I then do is after I've gone through and I've done this, and let's see what it's doing. There we go. What I then do is I'm going to go ahead and copy and paste this all the way down. Okay, so I'm going to do that and I did it here for the past 3 years. Many of you might be wondering, well, why does this company not have a December 31st year end? The answer to that is that most retailers will not use December 31st because of all the different returns and the like. Most of them will choose to do the month after the year end, or basically the month after the end of the calendar year. So as I come over here so this is for Lowe's, and I did the same thing for Home Depot. And let's go over here and take a look at their earnings. Okay, so one of the things we kind of notice is that for here, and we're kind of looking at this on both sides, as we've got here, my gross profit for Home Depot is roughly about 34.5%. For Lowe's, it's about 34.11%. The selling, general, and administrative costs is about 17.7% for Home Depot, whereas over here, it's almost 22% or 5% higher. Now, what's important to know is that even though Lowe's has a higher percentage of total selling and general administrative costs relative to sales, as a dollar for dollar basis, Home Depot is higher than that of Lowe's, okay? And the reason why the percentage is lower is because when you're dividing this by the total sales, you're getting to about 17%, and Lowe's is about, 32% less in terms of total revenue than Home Depot. So it's really important to go through here and kind of keep that in mind, is like, what are the relative size? So in absolute dollars, the selling, general, administrative costs are less than Home Depot, but from a percentage wise, it's higher. So I would probably be asking, if I was Lowe's, is that why is Home Depot so efficient in that one particular area? So now over here, when I'm over here on Home Depot, and I've got here my net earnings are about 8.6 billion. Yes, billion, or about 8.55%. For Lowe's, it's about 3 billion, or about 5%. So again, it's a way of going through and saying, well, why is Home Depot more profitable on a dollar per dollar basis than a company like Lowe's? So that's kind of the start of the analysis. And notice here, I am not doing anything in terms of percentages with the basic or diluted or the cash dividends per share. That's really important because that's like $4.09, and I'm really just comparing everything down to this line right here, which is my net earnings. When I go to my consolidated balance sheets, and this again right over here for Lowe's right here, they've got about $35 billion in total assets. For Home Depot, when I look at their consolidated balance sheets, and again, how did I get these numbers? Well, I'm taking essentially everything here. I'm taking cash and cash equivalents, and I'm dividing it by total assets. Okay, for those of you, this is like an old school Excel or sheets where I'm doing to make it so I'm only dividing these numbers by this amount. You use the dollar sign on these parts, but I'll let you take an Excel class for that. So right here, my cash and cash equivalents are roughly around 8%. And over here, my merchandise inventory for Home Depot is 28% of my total assets. When I look at over here, Home Depot, or assuming this is for Lowe's, Lowe's is it's about 32% of their total assets. But notice here, Lowe's has, I don't want to call it a liquidity problem, but right here, they've got about 588 million, or it's about 1% of their total assets is in cash, opposed to Home Depot, which is around 8%. So the thing where you get into more great questions is when I look over here in terms of the current liabilities or accounts payable. Here, Home Depot has roughly about 7.2 billion of accounts payable. And Lowe's has about 6.5 billion of accounts payable, and this was as of a year ago. So for Lowe's, it's about 18% of their total assets is in short-term accounts payable. Over here, it's about 16%. But what's a little bit different is that who would you want to do business with? If I was exclusively just looking at these financial statements and nothing else, I would be somewhat concerned if I was doing business with Lowe's. And the reason is, well, they have a lot of accounts payable already. And then up here, you've got not a lot of cash. For Home Depot, you've got here 7.2 billion of accounts payable, but here you've got about 3.5 billion of cash. What's really interesting about these two companies, as you look at here, you'd say, oh my goodness, Home Depot, they've got total assets here of roughly $44 billion, but they have liabilities of $43 billion. So that must mean that these guys are so leveraged that they're about to go broke. The thing about Home Depot, which makes it a very interesting company, is they have literally been swallowing themselves for the last several years. This is what we call something called treasury stock. What is treasury stock? Treasury stock is when I go out and I repurchase my own shares. Home Depot has repurchased, as of last year, about 622 million shares, and that's about a third of their total outstanding shares that they've issued. So when you see this in reality, if Home Depot would have, instead of not buying back their own stock, if they would have just had that up here in terms of cash, it's a lot different. It's a very, very different company. So you have to remember these kinds of things when you're going through and looking at the financial statements. So Home Depot is actually, even though their assets even though their liabilities are a huge percentage of their total liabilities and shareholders' equity, you have to remember that they went out and they repurchased a bunch of their shares that they could turn around and sell tomorrow. So that's something to just kind of consider. Over here for Lowe's, they didn't do that. They don't have any kind of treasury stock. That's what makes them very, very different as a company. But right over here, Lowe's has got about 29 billion of liabilities compared to 35.2 billion of assets. And then over here, they've got total liabilities and shareholders' equity of about 35.2 billion. So going back to these two companies, the thing we want to remember is that if I'm going to be doing a ratio analysis, I need to make sure that I'm choosing ratios that are meaningful to my company. I don't see any receivables here for Lowe's. Do I see receivables here for Home Depot? Yes, it's a very, very small amount. It's below 5%. So I would more than likely choose not to use a receivables ratio if I was comparing these two companies together. I would probably want to get a sense in terms of what is in that receivables amount of $1.9 billion. But I could probably do that by looking at the footnotes to Home Depot's financial statements. I have an assumption that that's really how they're getting in more with contractors. So that's kind of how we go through and do common size financial statements. The real purpose is to show the significance of the different accounts. The next step that we would be going through and doing is, instead of looking at these side to side and me continuing to go back and forth, is we would put them on a similar sheet. One of the things I've done in the past is I have written articles for Rogers CPA Review. Rogers CPA Review, great review course, an amazing instructor. He's a total spaz, but he will help you learn the material. Remember, with CPA Review, they're all great courses. I've had students who have passed the exam using every single different one. You just need to remember that if you are going through and taking the CPA exam, you want to be finding something that you're going to be using online so that you can study, 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 and then you can party, party, party. And those are in the words of Roger Phillip. So right over here, I've on Roger's blog, if you type in Tchaikovsky, you can find this, or you can go to my faculty website at IVC. What I've done is that this is kind of how when I teach financial analysis, this is what I go through and do is I look at like right over here, you know, how do you go through and you find like these various different companies, and then here's an example. This will take you to another Google sheet up here, which is comparing Lowe's and Home Depot. So this is from an earlier set of financial statements. And what this goes through and does is right over here, I'm really kind of going through and I'm comparing each one of these. So I have cash and cash equivalents here for Home Depot has the receivables of 4.7%. So again, this is, once I'm done with everything, this is going to really help me choose which ratios. So for example, here, I would want to be looking at merchandise inventory because it is such a large percentage. Property, plant, and equipment, probably also something I'm going to be looking at just in terms of, just because of the size of it on its balance sheet. And as I go down here to the income statements, we can kind of see things change over periods of time. Again, looks like that, you know, Lowe's has always been running higher in terms of SG&A, and this was even back as of February 3rd, 2017. So it's, again, it's a way that we can go through and help us analyze various different companies. So those are common size financial statement, which is a tool that we can go through and use when we are going through and comparing publicly traded companies. Thank you for watching the video, and I will see you on the next one. Please make sure to like and subscribe, and I will see you soon.